In 1929, a German archaeologist named Julius Jordan pulled a small clay tablet out of the ground at Uruk, in what is now southern Iraq. The tablet was the size of a credit card. It had been baked into permanence by a building fire roughly 4,000 years before he found it. The cuneiform script pressed into its surface recorded a transaction. A merchant named Dumuzi Gamil had borrowed 500 grams of silver from 2 lenders, agreeing to repay the silver with interest over a defined period. There was no money in Uruk in 2050 BCE. There were no coins. Coins had not been invented yet. They would not be invented for another 1400 years. And yet there was a contract written in formal legal language specifying a principal, an interest rate, a repayment schedule, and the names of the witnesses who would enforce it if Dumuzi Gamil failed to pay. This single tablet and the roughly 500,000 other Mesopotamian financial tablets that have been recovered from sites across the ancient Near East in the last 150 years demolish one of the most persistent assumptions in modern economics. That assumption is that money came first and credit grew out of it later. The historical record says the opposite. Credit came first. Money came thousands of years later. The ledger predates the coin by something between 1500 and 2000 years. Everything you assume about how money and finance work in the modern world is built on top of a structural arrangement that was already 4,000 years old, before the first piece of stamped metal currency was ever struck. And the rules of that arrangement, written into clay in Sumerian temple complexes around 2400 BCE, are almost identical to the rules governing your credit card statement this month. To see how that happened, you have to start in Mesopotamia, before the wheel was widespread, before the alphabet had been invented, and watch as the basic engineering of credit was assembled, tablet by tablet, in the temple precincts of cities that no longer exist. The ancient region of Sumer in southern Mesopotamia was the first place on Earth where large numbers of human beings lived in dense, settled communities. By 3000 BCE, the city of Uruk had a population of approximately 40,000 people. By 2500 BCE, the city of Lagash had approximately the same. These were enormous urban concentrations for the time. The agricultural systems that fed them were among the most productive in human history, but they had a problem that smaller societies did not have. The problem was that the food did not arrive in the city by itself. Grain was grown on irrigated plots outside the city walls. It had to be harvested, transported, stored and distributed. Livestock was raised at the edges of the settlement and brought into the city to be slaughtered. Wool was sheared from sheep and processed by weavers. Pottery was made by potters. Beer was brewed by brewers. Bricks were fired by brickmakers. None of these activities happened simultaneously. The settlement required a method of allowing economic exchange to occur even when the goods being exchanged were not physically present at the same moment. The Sumerian solution was the ledger. The temple complexes that dominated the centers of every major Sumerian city served, in addition to their religious functions, as the centralized accounting offices of the urban economy. The temple of the goddess Inanna at Uruk, the temple of the god Enlil at Nippur, the temple of the moon god Nana at Ur. Inside these complexes, scribes maintained records, pressed into clay with a reed stylus, of who owed what to whom, when the debt was incurred, when it was due, and what would happen if it was not paid. The temple was not, in any meaningful sense, a religious institution that happened to do accounting on the side. The temple was the bank. The Harvard anthropologist David Graeber, whose 2011 book, Debt, the First 5,000 Years, assembled the modern academic case for the priority of credit over money, documented this point exhaustively. The earliest economic records ever recovered from any human civilization are not records of barter. which the standard economic textbooks describe as the precursor to money. The earliest records are records of credit. The temple advanced grain to a farmer at planting time. The farmer repaid the temple with a portion of the harvest, plus a surcharge at the end of the growing season. The temple advanced wool to a weaver. The weaver repaid the temple with finished cloth at a defined exchange rate 3 months later. Every transaction was a credit transaction. Nothing changed hands at the moment of agreement except marks on a clay tablet. Graeber's central observation, drawing on a generation of Assyriological scholarship that the economics profession had largely ignored, was that barter, the supposedly natural precursor to money, appears essentially nowhere in the early historical record. Anthropologists who actually studied societies without coinage discovered repeatedly that those societies did not run on barter. They ran on credit. Goods moved between members of the community on the assumption that the favor would be reciprocated. Eventually, in some equivalent form, the ledger that kept track of the obligations was sometimes a piece of clay, sometimes a knotted rope, sometimes only the collective memory of the village elders, but it was always a ledger. The accounting always came first. The Sumerian innovation was not credit itself. Credit had probably existed in some informal form in every settled human community. Since the agricultural revolution, the Sumerian innovation was the standardization of credit at urban scale. The introduction of a single unit of account, the shekel of silver, weighing approximately 8 1/3 grams, meant that every debt in the city, regardless of what physical good it was originally denominated in, could be expressed in a common abstract currency. A debt of 3 sheep, a debt of 50 litres of barley, and a debt of 20 days of unskilled labour could all be converted into shekels and recorded on a single tablet, in the same ledger, comparable to one another for the first time. The shekel of silver was not, in this early period, a coin. Coins had not been invented. The shekel was a unit of account. The silver existed as a notional reference standard. Almost no actual silver moved between most parties to most transactions. The temple recorded the debt in shekels. The debtor paid in barley or wool or labour. The temple's scribe converted the payment into shekel equivalent and cleared the entry from the ledger. Silver, as a physical substance, was rare in Mesopotamia. Most of the silver in the temple treasuries had been imported from Anatolia at considerable expense. Spending it on routine transactions would have been absurd. The silver was the measuring stick. The actual exchange ran on credit. And then, sometime around 1755 BCE, in the city of Babylon, the structural rules of the entire system were codified in a single document that has survived to the present day. The Code of Hammurabi is one of the most studied legal documents in human history. It was discovered in 1901 by a French archaeological expedition working at Susa, in what is now western Iran. The original stone stele, more than 2 meters tall, sits today in the Louvre. The code contains 282 laws covering every aspect of Babylonian civil and criminal life. Approximately a third of those laws are devoted to financial matters: loans, interest rates, collateral, default, bankruptcy, slavery for debt. Hammurabi set the maximum legal interest rate on loans of silver at 20% per year. On loans of barley, he set it at 33 1/3% per year, reflecting the higher risk and lower portability of grain compared to metal. These rates were not arbitrary. They had been worked out over centuries of Sumerian and Akkadian practice. They represented what the temple economies had learned about the relationship between risk, return, and the long-run sustainability of a credit-based urban society. And Hammurabi understood, almost 4,000 years ago, the central instability that every credit system has faced ever since. The instability is this: compound interest, left to run for any extended period, will eventually exceed the productive capacity of the economy. Debts accumulate faster than the underlying economy can grow. Debtors who cannot pay become debt slaves. The free population of the city erodes. The army cannot be recruited because too many men have been sold to their creditors. The city's military and economic capacity collapses. The Babylonian solution to this structural problem was the periodic debt cancellation. Hammurabi and most of his successors on the Babylonian throne would, at irregular intervals, usually upon their accession to the throne or in years of agricultural crisis, issue a royal decree cancelling all consumer debts in the kingdom. Commercial debts between merchants were sometimes exempted. Debts secured by collateral were sometimes exempted, but the basic personal debts owed by farmers and labourers to creditors were wiped clean. The Akkadian word for this decree was andurarum, meaning approximately restoration. The Sumerian word was amagi, meaning literally return to the mother. These debt cancellations were not rare. The economic historian Michael Hudson, who has spent 40 years working with cuneiformist colleagues to assemble the surviving record of Mesopotamian debt jubilees, has documented at least 30 separate Babylonian decrees of andurarum in the surviving tablets between roughly 2400 BCE and 1600 BCE. The cancellations were so structurally important to the survival of the Babylonian economy that the kings explicitly built them into the system. The debts were allowed to accumulate during normal years. Periodically, when the accumulation reached the point of threatening the social order, the king wiped the slate clean. The economy reset. The cycle began again. The Hebrew Bible inherited this idea directly. The book of Leviticus, in chapter 25, prescribes a jubilee year every 50 years, in which all debts shall be forgiven, all debt slaves shall be freed, and all land sold under economic distress shall be returned to its original family. The Hebrew word for this year, Yobel, is the linguistic ancestor of the English word jubilee. The institution was so foreign to ancient Greek and Roman experience that when the Greek translators of the Septuagint rendered the Hebrew Bible into Greek in the 3rd century BCE, they had to coin a new term for it. The Mesopotamian debt jubilee, in its Hebrew form, became one of the structural concepts that Western religious tradition would carry forward into the modern world, even when the actual practice of Jubilee was forgotten. And the practice of Jubilee was, in fact, forgotten. The Roman Empire, which inherited many institutions from the Eastern Mediterranean, did not inherit the periodic debt cancellation. Roman law instead developed the institution of debt slavery, the right of a creditor to seize the body of the defaulting debtor and use the debtor's labor until the debt was extinguished. The Roman Republic experimented with debt slavery for several centuries before formally abolishing it in 326 BCE. Under the Lex Potilia, which restricted the creditor's claim to the debtor's property only. The Roman shift was, in retrospect, one of the most consequential institutional decisions in Western financial history. It established the principle that a person's labor could not be permanently encumbered by their debts. It did not, however, establish any periodic mechanism for clearing accumulated debts from the system. The Mesopotamian solution had been abandoned. The Roman replacement was not a replacement, it was an avoidance. The consequence, in Rome, was the recurrent debt crisis. The Gracchi brothers, Tiberius Gracchus, tribune of the plebs in 133 BCE, and his younger brother Gaius, tribune in 123 and 122 BCE, both attempted to pass land redistribution legislation specifically to address the unsustainable accumulation of farm debt among the rural poor. Both were assassinated. The Roman political class refused to clear the debts. The accumulated obligations contributed, by the end of the Republic, to the conditions that produced the civil wars of the 1st century BCE and the eventual collapse of the Republic itself. This is the pattern. Credit accumulates. The accumulation threatens the underlying society. Either the debts are periodically cleared, or the society eventually breaks. The Babylonians chose to clear. The Romans chose not to. The choice mattered. If you are finding this useful, hit subscribe. We cover deep histories of everyday money like this every week. After Rome, the next major architectural innovation in credit did not come from a state. It came from a religious military order founded in Jerusalem in 1119 to protect pilgrims traveling to the Holy Land. The Knights Templar were originally a small group of 9 French knights, led by a man named Hugues de Payan. Within 50 years, they had become the largest international financial institution in medieval Europe. They had not set out to become bankers. They became bankers because pilgrimage required them to solve a transportation problem, and the solution they engineered was so commercially powerful that it grew into a business empire. The transportation problem was this: a pilgrim setting out from France or England to travel to Jerusalem in the 12th century needed to carry enough money to fund a journey of perhaps 18 months across roads and seas full of bandits and pirates. Carrying that much physical coin was an invitation to robbery. The Templars, who maintained fortified preceptories along the major pilgrimage routes across France, Italy, and the Levant, offered an alternative. A pilgrim could deposit a sum of money at the Templar preceptory in his hometown. The Templars would issue a receipt, a small folded letter, signed and sealed, written in a cipher only Templar scribes could read. The pilgrim would carry this letter across Europe. At any Templar preceptory along the route, he could present the letter and withdraw the deposited funds in local currency, minus a small fee for the service. This is, in functional terms, the modern letter of credit. The Templars had reinvented an instrument that the Sumerian temples had used 4,000 years earlier, the abstract recording of obligation that allowed value to move without physical metal moving. By the early 13th century, the Templar preceptory in Paris, the Temple Tower, was the central treasury of the French crown. The Templar preceptories in London and Acre and Constantinople moved sums of money between European kingdoms at a scale that no merchant bank had ever achieved. The order's military function, the protection of pilgrims and the prosecution of the Crusades, had become almost secondary to its financial function, and it ended in one of the most direct demonstrations in history of the relationship between debt and political power. By the early 14th century, King Philip IV of France owed the Templars an enormous sum. The exact figure is disputed in the surviving records, but it was sufficient to threaten the royal treasury's solvency. On Friday, the 13th of October, 1307, Philip ordered the simultaneous arrest of every Templar in France. The order's Grand Master, Jacques de Molay, was tortured for years and eventually burned at the stake in Paris in March of 1314. The Templar treasury, which Philip seized, did not, according to contemporary accounts, contain the wealth he expected. The records that would have proven what he owed were destroyed in the suppression. The debt was, in the most direct possible way, cancelled by the destruction of the creditor. It is one of the cleanest historical examples of the structural fact that all credit ultimately rests on the political authority that enforces it. Remove the authority, and the debt evaporates. After the Templars, the institutional centre of European credit moved to northern Italy. The Florentine banking families, the Bardi, the Peruzzi, and, beginning in the early 15th century, the Medici, developed the techniques that would define European banking for the next 400 years. The most important of those techniques was the bill of exchange. A merchant in Florence who needed to pay a supplier in Bruges did not ship gold across the Alps. He purchased a bill of exchange from a Florentine bank. The bill instructed the bank's Bruges correspondent to pay an equivalent sum in Flemish currency to the supplier. The merchant had paid in florins. The supplier received pounds groot. No physical metal had moved. The two banks settled their balances against each other periodically, often by cancelling reciprocal claims at the great trading fairs in Champagne or Lyon, with only the net difference ever needing to be moved as physical coin. This is the same mechanism. The Templar letter of credit, the Florentine bill of exchange, the medieval merchant fair settlement, all of them were technical implementations of the same Sumerian principle. Credit moves value without metal moving. The metal is the unit of account. The credit is the actual economy. By the time the Bank of England was founded in 1694 by a Scottish merchant named William Paterson, the basic architecture of modern credit was essentially complete. Paterson's bank was chartered to lend the English crown £1.25 million at 8% interest, with the loan funded by selling shares in the bank to the public. The bank held the king's debt as its primary asset. Against that asset, it issued paper notes, banknotes, that circulated as money. The notes were redeemable, in theory, for gold from the bank's vaults. In practice, only a small fraction of the notes were ever redeemed at any given moment. The bank ran on the assumption that the public would treat the notes themselves as money, which the public, after some initial skepticism, did. This is the moment at which credit and money formally merge in the modern sense. The Bank of England's notes were credit instruments. They were also money. They were both at the same time. Every banknote in your wallet today is a direct descendant of these instruments. A dollar bill, or a euro note, or a pound sterling note is technically a promise issued by a central bank, a credit obligation denominated in an abstract unit of account, backed by the political authority of the issuing state. The piece of paper has no intrinsic value. Its value is entirely the value of the credit relationship it represents. And the consumer side of credit, the credit card, the personal loan, the mortgage, emerged in its modern form only in the 20th century. The first modern credit card was the Diners Club card, introduced in New York City in February of 1950 by a businessman named Frank McNamara, who had, the previous year, taken a client to dinner at a Manhattan restaurant called Major's Cabin Grill, and discovered, upon trying to pay the bill, that he had left his wallet in another suit. The embarrassment, according to the story Diners Club has repeated for decades, gave McNamara the idea of a charge card that could be used at multiple restaurants under a single account. By the end of 1950, the Diners Club card was accepted at 27 restaurants in New York. By 1951, it had 35,000 cardholders. By 1958, when American Express launched its competing card, the consumer credit card industry was an established commercial category. Bank AmeriCard launched in 1958 in Fresno, California, as the first credit card that allowed revolving balances, the option to pay only a portion of the monthly bill and carry the remainder forward with interest. Bank AmeriCard became, in 1976, Visa, the Master Charge Card, introduced in 1966 by a consortium of California banks competing with Bank AmeriCard, became, in 1979, MasterCard. By the early 1980s, the revolving consumer credit balance owed by American households had reached approximately $55 billion. By 2024, according to the Federal Reserve's monthly G.19 release on consumer credit, that figure had reached approximately $1.33 trillion. The launch of Bank AmeriCard in Fresno is worth pausing on because it included one of the most consequential and least examined commercial decisions of the 20th century. The Bank of America, which originated the card, did not run a slow pilot program. The bank mailed 60,000 active, ready-to-use credit cards to residents of Fresno without those residents having applied for them. Anyone receiving the card could use it immediately, on credit, up to a defined limit. The strategy was called the Fresno Drop. It was, in the language of behavioral economics, that would not be developed for another 20 years. A default in technique, recipients did not have to opt in to credit. They had to opt out of it. Most did not opt out. Within 3 months, Bank of America had extended live credit to 2 million Californians using the same method. The default loss rate was vastly higher than the bank had projected. The fraud rate was higher still. The first 2 years of the Bank Americard program lost the bank. By some estimates documented in Joe Nocera's 1994 book, A Piece of the Action, approximately $20 million in unrecovered balances and fraudulent charges. The losses were absorbed. The market position was secured. By the time Bank of America licensed the Bank Americard system to other banks across the country in 1966, the foundation of the modern American consumer credit economy had been laid. The structural decision that credit would be offered first, applied for second, has defined the American consumer credit market for 65 years. The shift to revolving balances was the second structural decision, and it was arguably even more consequential. Before the introduction of revolving credit, American consumer borrowing was almost entirely installment credit. A customer purchased a refrigerator on time, made fixed monthly payments over a defined period, usually 12 to 36 months, and the debt was extinguished on a known date. Revolving credit ended this. The balance could be carried forward indefinitely. The customer was no longer paying down a defined debt. The customer was renting access to a permanent line of credit at an interest rate that compounded month after month. The Mesopotamian principle that compound interest left to run for any extended period would eventually exceed the productive capacity of the borrower had been engineered directly into the design of the consumer financial product. The average American household carrying a credit card balance now pays interest at a rate above 20% per year. This is almost exactly the maximum legal rate that Hammurabi set on loans of silver in 1755 BCE. 3,780 years of financial innovation have produced an interest rate that, at the high end of the consumer credit market, is functionally identical to the rate the Babylonians considered the upper limit of what a credit-based society could sustain without collapse. And the periodic debt cancellation, the institution that Babylonian kings used for 1,500 years to keep their economies functional, no longer exists in the modern world. The Mesopotamian Andurarum, the biblical Jubilee, the structural circuit breaker that every long-duration credit system in history has required, has been removed from the design. The accumulation runs continuously. The economy expands. The debts expand with it. The system holds, as Hammurabi understood it would, only as long as the underlying productive capacity expands faster than the obligations. When that ratio reverses, the system breaks. This is the 4,000-year-old structure that every modern household balance sheet sits on top of. The merchant Dumuzi Gamil borrowed his 500 grams of silver in Uruk around 2050 BCE, under terms that would be legible to a modern loan officer. The Sumerian temple kept its ledger in cuneiform. The Bank of England keeps its ledger in digital ones, and zeros stored in a server farm in Threadneedle Street. The accounting language has changed. The structural arrangement has not. Money, in the form the modern world recognizes, coins, banknotes, digital balances, is a recent invention layered on top of a far older system. The system that came first was the ledger. The shekel of silver was, at its origin, a number written in clay. Most of the silver was never moved. The credit was the economy. Every transaction in the global economy today, every dollar that moves between bank accounts, every digital authorization that flashes across a payment terminal when you tap your card, is an entry in a ledger that traces its conceptual lineage, unbroken To the temple complexes of southern Mesopotamia 4,000 years ago, the form has changed beyond recognition. The underlying invention, the idea that economic value can be tracked, transferred, and enforced through nothing more than a record of who owes what to whom, was completed almost 2,000 years before the first coin was ever struck. The coin was the latecomer. The credit was the original technology. If this changed how you think about the balance on your account, the video on screen right now goes deeper into another piece of financial history hiding in plain sight.